Welcome back to the channel. Today we are diving into something that sounds almost like a conspiracy, but isn't. It's quiet, it's legal, and it's happening right under your nose. We are calling it the invisible thief. And no, it's not a hacker, not a market crash, not even inflation in the way you usually think about it. It's something much subtler. It's how mutual funds are evolving in 2026 and how that evolution is quietly reshaping your returns. If you invest or plan to, this episode might change how you look at your portfolio forever. This is Vinod from NRI Financial Insights. Let's start with a simple question. If your mutual fund shows a return of, say, 10% this year, did you really earn 10%? Most people would say yes, but the truth is, you probably didn't. Because what you see is net return after a series of small, often invisible deductions. Fees, taxes, structural inefficiencies, hidden trading costs, and now new dynamics emerging in 2026. Individually, they seem harmless. Together, they can quietly eat 20, 30, even 50% of your long-term wealth. That's the invisible thief. And in 2026, it's becoming smarter. So what's actually changing? Three major trends are rewriting the rules of mutual funds right now. The rise of algorithm-driven fund management, fee structures becoming more complex, not simpler, the silent dominance of passive investing and its side effects. Let's unpack each of these. In 2026, a large portion of mutual funds are no longer managed the way they used to be. Instead of a star fund manager picking stocks, many funds are now driven by algorithms. AI models analyze thousands of signals, market trends, sentiment, macro data, even social media. Sounds great, right? More data, better decisions. But here's the catch. These systems often trade more frequently, and more trading means more transaction costs, brokerage fees, slippage, taxes. These costs don't show up clearly in the expense ratio. They're buried inside performance. So again, you don't see them, but you feel them. Your 10% return might have been 12% or 13% before those invisible frictions kicked in. For years, investors were told, look for low expense ratios. And that advice still matters. But in 2026, fees have evolved. They are no longer just a single number. Now we are seeing performance-linked fees, dynamic expense ratios, hidden operational costs, fund of funds layering. Let me explain that last one. Some mutual funds now invest in other funds, which means you're paying fees on top of fees. A 1% fee might actually be 1.8% or more when everything is accounted for. And over 20 years, that difference can cut your final wealth by almost half. That's not an exaggeration, it's math. Now let's talk about passive investing. Index funds and ETFs have exploded in popularity, and for good reason. They are cheap, simple, and historically effective. But here's what's changing in 2026. When too much money flows into passive funds, markets start behaving differently. Instead of capital flowing to the best companies, it flows to the largest companies. Because that's how indices are structured. So big companies keep getting bigger, not always because they are better, but because they are already big. This creates distortions. And here's where the invisible thief sneaks in again. You might think you're diversified, but in reality, your fund could be heavily concentrated in a handful of mega cap stocks. If those stocks underperform, your safe investment suddenly doesn't feel so safe. Let's talk taxes, because this is one of the biggest invisible factors affecting your returns. In 2026, frequent rebalancing, especially in algorithm-driven funds, can trigger more taxable events, even if you don't sell anything. That means capital gains distributions, short-term tax hits, lower after-tax returns. And here's the frustrating part. You might owe taxes even in a year where your fund didn't perform that well. It feels unfair, because it kind of is. Now let's step away from the technical side for a moment. Because part of the invisible thief is actually you. Investor behavior plays a huge role. In 2026, with apps, instant data, and constant notifications, people check their investments more than ever, and that leads to panic selling during dips, chasing hot funds, switching strategies too often. Each move feels small, but over time, it destroys returns. Studies have consistently shown that the average investor underperforms their own funds just because of timing decisions. So sometimes the thief isn't the system, it's the reaction to it. Let's be honest, mutual funds are still a business. And in 2026, competition is fierce. So, what do companies do? They market performance. Top performing funds are everywhere: ads, apps, recommendations. But here's the problem: past performance is often temporary, and by the time a fund becomes popular, it may already be past its peak. You end up buying high, then reality catches up, and again, the invisible thief takes a cut. At this point, you might be wondering, should I just avoid mutual funds altogether? Not necessarily. Mutual funds still offer professional management, diversification, accessibility. But the key difference in 2026 is this: you can't afford to be passive about your passive investments. You need to understand what you're actually investing in. Let's get practical. Here's how you fight back against the invisible thief. First, look beyond the expense ratio. Check turnover rates, tax efficiency, and fund structure. Second, be careful with fund of funds. Understand layered fees. Third, don't chase performance. Consistency matters more than short-term wins. Fourth, consider tax-efficient vehicles where possible. And finally, stay disciplined. The biggest advantage you have is time, not timing. Looking ahead, mutual funds aren't disappearing, they are evolving. We are likely to see more AI-driven strategies, personalized portfolios, hybrid active-passive models, and possibly more transparency. But until that happens, it's your responsibility to stay informed, because the invisible thief thrives on ignorance. Let's bring this all together. In 2026, investing isn't just about picking the right fund, it's about understanding the system behind it, because what you don't see can hurt you the most. Fees, taxes, structure, behavior, they all add up, and over time, they can quietly reshape your financial future. So the next time you see a return number, ask yourself, what am I not seeing? That question alone could save you thousands, maybe even more. If you found this episode useful, make sure to subscribe, share it with someone who invests or wants to, and drop a comment with your thoughts. Have you noticed these hidden costs in your own investments? Let's talk about it. Until next time, stay informed, stay curious, and don't let the invisible steal your future.
Thanks for watching.